Hello, this is Eric Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting, and welcome to Charts of the Week for November 29th of 2021. Please see your disclaimer for important information. Well, I hope all of you had a wonderful Thanksgiving week with family, friends, good fellowship, good food, good time with family, and kind of disengaging from the events of the day for a little while. Now, while a lot of people were not paying attention to the market, we did have the development of the new strain of the coronavirus that became evident in South Africa. Now it's termed Omicron by the World Health Organization. And so the advent and the revelation of this news caused the markets considerable upheaval on a day where we normally get like 2.9 billion shares trading. Again, a holiday shortened week, volumes are typically extremely light. And we're about not quite 3 times that amount on Friday. And you can see here in this chart that trading volume, which you would expect on Wednesday and Friday surrounding the Thanksgiving day, would be lighter. But Friday was a lot lighter, or excuse me, well, a lot heavier than it would have been normally, especially considering that trading day was only about 3.5 hours. But what was revealed was that this coronavirus, which has now been labeled really an item of concern, and there's a lot that we don't know about it, a lot that we don't know with regard to how the vaccines react to it. It's very early on. Credit the South Africans for really stepping out and being transparent, where the Chinese certainly were not earlier this year. But anyway, the world was not anticipating this, just as the Delta wave was beginning to roll over. And so that caused considerable upheaval in our markets. So not only, as you can see here, major markets down over 2%. We did see the 10-year Treasury move from 1.64% to 1.49%. That is the largest decline in yields in a day that we've seen since March of 2020, which is at really the height of the pandemic anxiety. And we did see a big reversal in crude prices. We saw WTI, West Texas Intermediate crude, down 13%, which is the lowest level it's been in September. We've got some charts, a couple of charts on that. And then we also saw a bit of a kind of a fear trade, if you will, total fear, not based on any fundamentals whatsoever, moving away from kind of the more cyclical trades and into more the kind of the defensive early COVID type trades, moving out of transportation and hospitality, moving into some technology trades. And I think that's kind of a dangerous bet right now. And again, it was a fear trade based on relatively little information. I think we've got to be real careful about overreacting to these things and wanting to jump in the market when you don't have the information that you really do to make an informed fundamental decision about value. Here was a quick look at the federal funds rate moving on Friday. Obviously, the fears that were generated by the revelation of this B11529 Omicron virus, caused people to speculate that the growth rate in the economy and the pace of economic growth might slow, which would in turn cause the Fed to kind of reduce its accelerator on increasing interest rates. And so you can see here that it moved down just a little bit. So the expectation here essentially is that the Fed is going from maybe 3 rate increases to 2 rate increases next year, and we'll just have to continue to monitor this. This is subject to wide swings in sentiment. So here is the big deal about what we're calling Omicron now, and it seems in the very, very limited data that we have that its transmissibility is considerably higher than Delta. You can see that here, that Delta was 70% more transmissible than the original Alpha variant, and now Omicron seems to be almost 500% more transmissible in this very early data. Now, what we're going to have to wait and see is with the increased number of what they're what is termed as mutations, and like Delta had, I believe, 9, and Omicron has 32 different mutations. And some of these mutations are the same ones that we've seen before, but some need to be studied a little bit closer. And so really the issue here is how many of those mutations are ones that would potentially, help this particular variant to evade current vaccines and whatnot. And there's not as much known on that, but the good news is that under mRNA vaccine technology, those things can be altered fairly quickly. I was reading a lot over the weekend that seemed to suggest that this could be done in a matter of a couple of weeks, perhaps. And then obviously everyone's antenna is raised on this particular issue right now, and with the transparency that has been afforded us by the South African healthcare regime, it allows researchers to really get out in front of this a lot better. So as we sit here right now and we look at what's happening on the tapering front, again, this may change, but what I thought was really interesting here is to show that if the Fed, again, a lot of rhetoric has been made on the Fed tapering asset purchases or curtailing asset purchases. At some point, that's going to cease, and then the next step thereafter would likely be to start increasing short-term rates. Now, what this shows you here is that even as they're tapering, I mean, the Fed's balance sheet is not going down. In fact, it's still going up. They're still adding assets just at a decelerating rate. And so eventually those assets will roll over. But as we can see here that, with all the rhetoric about tapering asset purchases, that doesn't mean that they're going to be selling. They're just not going to be buying as much. So as we look at what's going on in the interest rate market, so on and so forth, again, this is apt to change as we kind of follow this Omicron variant here through the next week to 10 days. But we can see the probability of 3 Fed rate hikes, at least the pace of this acceleration as we've been witnessing this inflation data pass through us. And you can see that's on the left-hand side. On the right-hand side, you can see the 3-year government bond yield continue to move higher in response to this expectation that interest rates will move higher. Here on this slide, we've got a couple of things which really are, interestingly enough, or perhaps a little bit at odds with each other. Now, we just saw where interest rates are moving higher in response to the expectation that rates are moving higher, again, with the new strain of coronavirus. We'll have to see how that all plays out. And because we did see on Friday that the yield curve did flatten a little bit there. But here on the left-hand side, we have the 10-year break-even rate. And this is the implied inflation rate as priced into the Treasury inflation protected securities for the 10-year Treasury, or TIPS. Just literally over the last week, we saw that number drop from about 2.75 to about 2.62%, and it's jockeyed around. You can see that this data goes back basically a month, and you can see how it kind of moves back and forth. But I think the data is settling in about 2.5 to 2.7 is kind of that expected range of inflation looking out over the long-term horizon. So, what this tells you is that inflation expectations in the longer run remain relatively stable, and they're pretty well anchored around the Fed's price stability goal. And so that kind of suggests that households and businesses really expect inflation to moderate as the global economy emerges from the pandemic. And that also that it suggests that people understand that the Fed will act if inflation begins to look a little bit more persistent. Now, with that as a backdrop, on the right-hand side, we've got the dollar index, and you can see the dollar is moving higher. It's kind of breaking out here, which is interesting. Obviously, we've got higher interest rates amidst the backdrop where we've seen additional coronavirus economic measures being taken in the wake of that, and especially over this weekend in the wake of the new Omicron variant. But the dollar is really breaking out because you see a lot of outperformance in the U.S. relative to the rest of the world. Here's a quick check-in on personal consumption expenditures, and we've been talking about this. This is a measure of inflation that the Fed spends a lot of time looking at, and it's a timeline that takes us back to 2017, and you can see overall PCE. Again, this is not a surprise because we've been watching inflation, but we've really rocketed higher than our trend line pre-pandemic. And it's important to know where that's coming from, and it's coming from goods. If you look at the right-hand side, you've got that PCE broken up into services, which is running below its prior pre-pandemic trend line, and you've got goods down below that, which has really moved higher, considerably higher, as we know, during the middle of the pandemic and these various waves, goods demand went through the roof. It actually contributed quite a bit to the supply chain problems that we're witnessing today. Whereas services, as you might expect, when you still have closures or limited capacity, you're not going to get that rebounding nearly as fast. And I do continue to expect that these trends will hold fast over the next several months. As we kind of transition into the real estate market, we'll look at some data from Redfin here. And so what I thought was really interesting is that the investor interest in real estate, particularly residential real estate, single family residential, is really perked up. Obviously, we've got prices moving higher, which in some respects you think might chase some people away. However, that's clearly not the case. But the other big driver is rents here. And so we see rents moving higher. And so from an investor's perspective, that makes a property more attractive. And so what we're seeing here in this particular case is investor market share moving higher. We're above the pre-pandemic levels. We see in terms of unit demand, we see a tremendous amount of interest there. So here's a Homebuilder sales survey, and this is a measure of kind of sentiment within the home building industry. And we know that that number's been high. It's kind of leveled off a little bit during the summer months, but it's beginning to show a little bit more life. You can see that we're above 2020 levels, which was really strong. We did see a lot of stick building last year, and sentiment amongst builders was really, really strong. And you can see how that compares with 2019. So we're from a housing market perspective, at least in terms of sentiment, it looks really strong right now. Here is housing price to rent ratios, and this is you see some of these dashed lines represent some of these major markets, but the solid line there represents the median. You can see price to rent ratios remain relatively high. And so the read through on this is that you're going to get rents that are going to be chasing prices at some point. And you can see where, before the global financial crisis, where that range was, and you can see it's considerably higher than it is now. There was an awful lot of speculation, but then there was a lot of availability of credit. Credit was frankly too easy, and so you could see that these major markets really just hit a bubble and overheated. Now, where we are now is not in the same territory, but we are witnessing a lot of increase there in this particular data series. Something I wanted to see, I wanted to kind of analyze a little bit more was the consumer spending. And we know that consumers have been strong, household balance sheets remain strong. We've got a lot of equity in people's homes, a lot of cash out refinancings, especially with higher incomes with really good credit. And we've seen a lot of spending amongst the lower tiers, especially in the wake of some of the stimulus payments. Now, the stimulus stuff is gone, but we're still seeing really high consumer spending. So notwithstanding any of the noise that might be evident in the market, you still see consumers kind of put their money where their mouth is, and we know that sentiment indicators have been maybe a little softer lately, but clearly spending is really high right now, especially heading into the holiday season. Pop-up shops. I saw this in an article in the Wall Street Journal, and it just shows you that that we've seen a reemergence in at least some parts of the retail sector. So where we saw a net reduction in a lot of storefronts last year, we're actually seeing quite a pickup in 2021. Real private inventory. So this is a function of what's going on in the supply chain. It has a lot to do with that, and you can see that we're in the midst of recovering to a pre-pandemic trend line level, but we're not there yet. And I think this, notwithstanding anything that's going on with the new variant of the virus or anything like that, all other things being equal, I think inventory rebuild is going to be a real meaningful component of GDP or economic growth here over the next year. This is a very busy chart, but it shows you a lot of market cycle emergences from the trough of the cycle, or I guess what I'll call the commencement of the cycle. And you can see here that the commencement of the latest cycle was March of 2020, when we hit our low on March 23rd of last year for the S&P 500. Now this data is as of the 21st, so it doesn't include what happened here last Friday. But if you plot all these other market cycles at the same point as the trough of the most recent cycle, meaning that you take all these other cycles that have happened in the past and you say, where's the trough, and you index all of those trough points to the most recent one in March of last year, you can see how these other, how this latest recovery in the market has fared compared with the markets coming out of the troughs of these other market cycles. And you can see that we've actually fared pretty well with really only one exception in this entire data series. So this just highlighting the fact of how strong a recovery in the stock market we've seen coming out of this trough. So downside gaps. I saw this in some research over the last week, and it really made I think a little bit about the lack of volatility that we've seen. And when we have seen bouts of volatility, essentially 1% price moves up or down, and in this chart it shows you the various points where you have opening gaps down, like greater than 1%, meaning the market is opening more than 1% lower than it closed the previous day. And the red dots actually represent points where it gaps down on COVID news. And this is exactly what happened last Friday. So if you go back to March of 2020, we've had 11 days like this, and last Friday was the 11th day in this time series. And you can see here, we found the COVID strain in South Africa. But again, the takeaway here is that even though you've had these downside gaps, you honestly haven't seen a continuation of the downward trend. You see these gaps, and then you see a recovery relatively soon thereafter. Again, I'm not going to say past is prologue, but I think it is meaningful to look at this data and say, when you've had those gaps down, more often than not, they've been buying opportunities amidst this continued upside trend. So we'll talk about crude prices. Now, I mentioned that that energy prices were down last week. They were already trending down anyway, and we're getting the expectations that we're going to be getting more supply on the market coming up. Brent crude was down 12%. West Texas Intermediate on Friday was down 13%. You can see on the left-hand side, rig counts are improving, and that's, you know, we're generating more productivity on a per well basis. Right now, the producers, especially the marginal and independent producers, are much more focused on positive cash flow management and managing their profit and loss statements than they are about sheer production based on price. And so we're seeing a lot more discipline now than we have in quite a while in the oil patch. On the right-hand side, you know, we see that stocks are now 200 million barrels below their pre-COVID levels. So now these are, you know, various I guess, tranches or sleeves of crude inventory, and so there's definitely an unmet demand right now. We know that's a function of why prices are higher, but at the same time we're getting more rigs back online, getting more production as we look into the middle of next year. And we've showed some charts on this before, that environment, the energy market, actually looks a lot more. What am I trying to say? It's looking a lot more in equilibrium because of the increased supply potential coming on the market. In fact, you know, you look at this whole inflation basket and you look at the headline inflation numbers, having some moderation in energy prices actually could reduce that inflation rate inherently because of lower energy prices that we expect next year. Well, this is what happened on Friday. You can see, you know, we can see that the oil futures were coming down basically since the end of October, honestly. And so there was a gap down on Friday on this coronavirus news, and you can see what that looks like here on the left-hand side. And the other thing too, which I think is really important here, because, you know, you basically crack crude into all of its distillate products, kerosene, you know, oils, PVC, you know, all of these different products and distillates. Gasoline is obviously a big distillate product, and you can see the impact on the decline in crude prices is having a corresponding impact on gasoline futures. And so what this means, quite frankly, is that, you know, the higher prices at the pump, which people are seeing right now, should go down, right? And so there is no clear manifestation of what inflation looks like from a consumer's perspective than what you have to pay to fill up your car every time you have to fill it up, because you know what that dollar looks like, and you know it's real money when it costs you $45 to fill it up and suddenly it costs you $80. You see that and you feel it, and it's more visceral, and that affects consumer behavior. But when you have a corresponding decrease in the price of gasoline at the pump, that tends to increase confidence, tends to increase spending, tends to increase, you know, overall economic activity. I found this chart looking through a few things this week, and I was curious, and we had actually some conversation about nuclear power over the holiday weekend, and so I was curious about where that stood, and the sentiment factor, frankly, is improved. You know, it's a clean energy. Obviously, you have a kind of a fat tail risk, though, if you have some type of a meltdown or have, heaven forbid, like a Fukushima type incident where, you know, you've got flooding and then you have kind of an uncontrolled situation at your hands on radiation. That's a huge cost and huge expense, and, you know, the type of issue that can persist for generations in terms of radiation. But anyway, the bottom line is that those are very small probability cases, what we call value at risk, a small probability but a high cost if you hit it. But if you're able to, manage those risks ably, nuclear power in the face of all of this rhetoric on ESG and clean energy actually provides some pretty compelling energy prospects for a country that continues to grow. Again, I'm not making a political statement on this. I'm just reflecting the fact that it seems like as we go along, that especially over the last year or so, that the favorable percentages for nuclear have increased. Thanksgiving weekend shopping, expecting that to increase this year. By the time you hear this, obviously we'll know a lot more than these estimates suggest, but we are expecting to see a definite improvement year over year. Gas prices, we just talked about that, $3.35, $3.35 at $3.50, even $5 or more, depending on some areas of the country. This is a real impact, and so the fact that we are getting ready to get some probably some relief on that is going to be profound. And where Americans shop for the holidays from Statista, I thought was really interesting. Not a terrific surprise, online being number one, but department stores, number two at 47%. So we're seeing more activity in the malls. We're seeing a lot of activity in discount stores. Grocery stores is pretty interesting. Clothing, which has been a real struggle during the pandemic. A lot of apparel sales still remain low because people aren't, buying new outfits for work because they're working from home and they don't need it, and so on and so forth. So, but department store is probably the most surprising one in this chart, as hard as that side of the real estate market has taken it on the chin here lately. And lastly here, something I came across in a Wall Street Journal article. Again, I'm not waxing political here. It's just really interesting that as technology has evolved, even if we complain about having more violent storms out there, the death rates from these violent storms, and this is not just U.S., this is global, have decreased dramatically over time. And so the technology to anticipate bad weather events, or bad, type of geological type events and things like that has improved to the point where we're able to save more lives. It doesn't have, it has probably a tangential economic benefit in the sense that, recovery costs are not being incurred. In some cases, you get a lot of economic benefit from having to recover an economy from some type of a natural disaster. But that's not why I put the slide up there. It's just I thought it was pretty interesting that how profound this chart has gone down over the last 100 years. That's all we got this week. Hope everyone has a wonderful start to their December month as we enter the final month of 2021. On behalf of the entire team at BKA Wealth, look forward to seeing you again next week and hope you have a wonderful week. Take care. Bye-bye.